Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, a 92,000 job loss rocks the US economy, yet a Fed official puts rate hikes back on the table, creating a major policy dilemma. We'll examine how this policy conflict challenges the Fed's dual mandate and how it could reshape the outlook for interest rates in the economy. Second day, 17% oil price surge rattles global markets after Hormuz disruption, but the S&P 500's calm response signals a high-stakes bet on de-escalation. We'll explore how this market complacency is being tested and what a prolonged conflict could mean for global inflation and central bank policy. Third, Venezuela becomes a coiled spring of opportunity for US investors, sparking a race for oil assets and a massive $100 billion debt restructuring. Today, we'll take a closer look at this investor scramble and its implications for the distressed debt market and US-China resource competition. The US economy just lost 92,000 jobs. That's not a typo. In a stunning reversal, the latest government data shows hiring has turned negative, pushing the unemployment rate up to 4.4%. This figure comes from what's called the Establishment Survey, which polls businesses. What's even more concerning is that the job numbers for the previous 2 months were also revised down by a combined 69,000. This shows a clear trend of a cooling labour market, not just a one-off bad report. In any normal scenario, that kind of number would have the Federal Reserve racing to cut interest rates. That's because of the Fed's dual mandate to achieve maximum employment and stable prices. A sharp rise in unemployment directly threatens the first half of that mission, but this isn't a normal scenario. Just as this bombshell jobs report dropped, a voting member of the Fed's rate-setting committee went on the record with a statement that has investors scrambling. Cleveland Fed President Beth M. Hammack warned that if inflation doesn't start making significant progress towards the 2% target, the central bank might have to consider getting even more restrictive. And yes, that means a rate hike could be back on the table. This could signal a fundamental shift in the Fed's thinking. Recent minutes from the Fed's own meetings show that a majority of policymakers now believe the risk of high inflation is a greater danger than the risk of rising unemployment. This is what economists call a change in the reaction function. The Fed might be willing to accept a weaker job market to make absolutely sure inflation is defeated. This puts the Federal Reserve in an impossible bind. Surging oil prices and persistent inflation are fueling arguments to keep rates high or even raise them to prevent the public from expecting high prices forever. And this isn't just about oil. What's amplifying the problem is the pre-existing US import tariffs. Research from the Federal Reserve itself shows that almost 100% of the cost of these tariffs is passed on to American importers and consumers. When you combine that with an energy price shock, you get a dangerous inflationary spiral. Hammack herself noted that inflation might not hit the Fed's target until 2027. When we place the Fed's goal of fighting inflation alongside this sputtering job market, the contradiction becomes clear. The backstory here is that for the past couple of years, many companies have been hoarding labour, holding onto workers, even if business slowed down because it was so hard to hire. The divergence between the big drop in payrolls and the smaller rise in the unemployment rate might be a signal that this labour hoarding is ending abruptly. The loss of 92,000 jobs bolsters fears of serious labour market vulnerability, a situation that would typically demand a rate cut to stimulate the economy. Last year, the Fed cut rates even with inflation overshooting its target, specifically to support the job market. Now, the central bank is caught between two opposing forces. It faces a choice between fighting stubborn inflation and preventing a fragile job market from cracking. The Fed is now navigating a minefield where every potential move to solve one problem could make the other one catastrophically worse. So, what's the real canary in the coal mine? As Cleveland Fed President Hammack herself mentioned, it's the troubles in the private credit market. This is a $1.3 trillion market of non-bank lending that is largely unregulated and opaque. Unlike the 2008 crisis, which centered on big banks, a downturn here could trigger a sudden credit crunch with very little warning, spilling over into the public markets. As default rates in this sector begin to rise, it could be the first real test of this new financial world and potentially force the Fed's hand, regardless of what inflation is doing. This makes the next few months absolutely critical for observing how these opposing forces resolve. We were just talking about the conflicting pressures on the Federal Reserve, including oil prices. Well, that situation just took a dramatic turn. The first shockwave hit Asian markets with the South Korean stock market collapsing 13% in a single session, its worst day in history. A while back, we flagged that markets were underpricing the tail risk of a real sustained closure of the Strait of Hormuz. That risk premium has now moved front and center. For a market like South Korea, this is a textbook example of how energy shocks create a massive divergence between energy importing and energy exporting nations. As a major energy importer, when oil prices surge, its terms of trade, the ratio of its export prices to its import prices collapses. It has to pay much more for the energy it needs, which acts like a massive tax, draining purchasing power and crushing its currency, the won. For Chinese-speaking listeners, this highlights a similar vulnerability for China, which is the world's largest crude oil importer. Any sustained disruption puts enormous pressure on energy security in the economy. As we mentioned a while back, nearly a third of China's crude imports typically pass through this choke point. One reason Beijing has been accelerating overland pipeline options from Russia and Central Asia, and for Europe, after the pivot to Qatari LNG, disruptions here squeeze gas flows too, not just oil. The cause? The closure of the Strait of Hormuz, a choke point for a fifth of the world's oil and gas, sent global oil prices surging 17% to over $85 a barrel. We previously walked through tankers piling up near Fujairah and those no ship is allowed to pass broadcast. This isn't a blip. It's the risk premium finally being paid. But here's a twist that has Wall Street on edge. While Asian markets were battered, the S&P 500 barely flinched, losing less than 1%. Investors are making a high-stakes bet that this will all be over in weeks, assuming a quick backdown in the conflict. The US market seems to be operating on a different logic, largely based on the belief in a so-called Trump put, the idea that the administration will ultimately act to de-escalate to protect asset prices. But this belief is now being tested in a live fire situation. Now, here's where it gets interesting. The market's pricing of risk has become dangerously low. We can see this in indicators like the CBOE crude oil volatility index, which had been pricing in very low future volatility. Believe it or not, this suggests investors are not buying insurance for a longer conflict. If this Trump put narrative fails and the conflict drags on, the market will be forced to rapidly reprice this geopolitical risk, which could trigger a sudden broad-based sell-off. The market's calm has experts sounding the alarm. One chief economist at AMP said he was worried that markets are a little bit complacent, adding, "The mildness of the response has surprised me." He's not alone. A senior portfolio manager warns what is different this time is that this could be longer lasting, and that could be a really big difference. If this conflict does drag on, economists warn a sustained move toward $100 oil could push inflation in countries like Australia above 5%, creating a stagflationary nightmare for central banks. The Reserve Bank of Australia's governor, Michelle Bullock, has already admitted this shock is different, stating publicly that there is a risk that inflation expectations might become a little bit unanchored. And that phrase, a little bit unanchored, is precisely what keeps a central banker up at night. The standard playbook is to look through a temporary supply shock and avoid hiking rates. But if the public starts to believe high inflation is here to stay, it creates a wage price spiral. At that point, a central bank may be forced to hike rates aggressively, even if it means knowingly pushing the economy into a deep recession. Markets are priced for a short shock. But with a fifth of global energy supply on the line, investors are walking a tightrope. So beyond the obvious headlines, the key thing to watch now is how businesses respond. The real danger is corporate capex paralysis. Companies unsure about the future simply stop investing. If we see the new orders and investment components in surveys like the ISM PMI start to fall, it's a major red flag that uncertainty itself is creating a recession. Speaking of oil supply, a development in South America could completely reshape the global energy map. So much so that one investor just called Venezuela a coiled spring of opportunity. After being a no-go zone for years, American capital is now flooding into Caracas. Following the capture of former President Nicolas Maduro and the re-establishment of diplomatic ties, a modern-day gold rush is on. The potential restoration of Venezuelan oil production is something everyone should watch, not just oil traders. We're talking about a potential ramp up to 1.4 million barrels per day within 2 years and maybe 2.5 million over the next decade. This could structurally cap long-term oil prices and act as a brake on global inflation. The stakes are colossal. with over $100 billion in sovereign debt needing a massive restructuring. Interestingly enough, the rapid repricing of defaulted Venezuelan bonds is being watched by Wall Street like a hawk. That's because it's a leading signal for this massive debt restructuring, and the outcome will serve as a bellwether for the entire distressed sovereign debt market. The recovery rate, how many cents on the dollar investors get back, is everything. Recent trades are already at 27 to 32 cents on the dollar, and a better than expected outcome could spark a rally across other high-risk markets. The interest is so intense that advisory groups are organising exclusive high-level tours for $7,000 a person. This investor tourism might seem strange, but it's actually a classic playbook for what are called frontier markets. Draft agendas include meetings with Venezuela's acting President Delcy Rodriguez, Finance Minister Anabel Pereira Fernandez, and the CEO of the state oil giant PDVSA, Francisco Emiliac. The scramble has caught Washington's attention. A White House spokeswoman noted that critical minerals, mining, and oil companies are moving at Trump speed. However, if you zoom out, you'll see another layer of strategy at play involving a major player, China. For years, China was a primary lender to Venezuela. The big question now is whether China will convert that debt into direct equity ownership of Venezuelan energy assets, creating a new flashpoint for US-China resource competition. This isn't just a single anecdote from a returning investor. It's a sign of a powerful economic phenomenon known as a reverse brain drain. For years, Venezuela's best and brightest fled. The return of this expatriate capital and talent, which is highly educated, could be a key growth multiplier, jumpstarting a more resilient recovery. But this isn't a simple comeback story. While investors are on the ground, significant US sanctions remain in place. As one trip organizer bluntly put it, actual transactions for the moment remain out of the question. This creates a high-stakes standoff in Caracas. Billions in potential capital are circling, yet the biggest deals remain untouchable. This brings us to the key focal points to watch as this story unfolds. First, the pace of that massive debt restructuring. Second, China's moves any debt for equity swaps will be a major signal. And finally, that reverse brain drain. These are the indicators that will tell us whether this coiled spring of opportunity will finally uncoil or get tangled in geopolitics.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.